Dear investor, in the first edition of Market Outlook for FY20 of calendar 2025, let us discuss the following. Valuations and our belief that it continues to be time for alpha. We will look at the macros. We will see flows, the domestic and FPI, and of course valuations. Now the first topic, well, calendar 24, the year that's just gone by, has been better than long period averages for market returns, with indices delivering mid-teens or better returns for large, mid and small cap part of the markets. Mid caps and small caps, particularly ahead of general elections and the budget, have delivered positive returns, while there were a lot of concerns around the space around the budget and the election period. We had continued to repose faith in spaces which delivered higher earnings growth in line with our belief that market follows earning growth adjusted for valuations over a period of time. The strong market performances has been in line with earnings growth that is being witnessed in various parts of the market. We believe that valuations are likely to be average for larger cap part of the market, as per long period averages. Now, if valuations are average, return expectations align with the growth in earnings for the index in a manner of speaking. Let's say financial 27 growth over financial 26 in earnings would be what an index may be expected to track. Now, on this base case, in case we get lower interest rate environment, it will give a positive impetus to the market and vice versa. Also, if the policy environment results in better earnings outlook for India Inc. or equity investors, it may help the market and vice versa. So that is the manner of looking at the markets. Now, lower regulated rates do seem like a probable scenario in the new year. Yes, Trump's protectionist measures could be inflationary and are expected to delay or lower the quantum of cuts that US is expected to see. But maybe, at 4.5%, bond yields are already reflecting the impact. Now, in India, RBI could also cut rates as we go deeper into the new year. As confidence increases, the Trump era could also see rate cuts, and our forex reserves, which have been weak for some time, again start moving up. Now, policy making may continue to be growth oriented in the country, and on this count also there is a possibility of a positive surprise. A risk is government spending driven sectors may see a squeeze as government strives to contain fiscal deficit further in line with the roadmap it has set for itself. Now, this would mean that the baton of capex growth passes on to the private sector, and hence private sector capex would be closely watched. We continue to believe that it is time for alpha. Now, while indices may do their bit, the country could offer an alpha opportunity to managers like never before. We hold the belief that market follows earnings growth corrected for valuations. Now, alpha is created when a new space which offers a long period of strong earnings compounding emerges. Now, since the space is new, it is less represented in the indices and hence presents an alpha opportunity. In the past periods, typically a period would witness emergence of one new space. For example, software emerged in the 1990s, private sector banks emerged in early 2000s, and real estate construction, for example, led in the 2005 to 2008 period. However, over the past few years, we have seen emergence of several strongly growing spaces such as electronic manufacturing, renewables, electric vehicles, new tech, luxury consumption, capital markets, defense, etc., and the list continues to expand. Data centers, nuclear energy, artificial intelligence are all expected to provide strong growth opportunities with time, and over time, stocks representing these spaces will appear in the market. So many new spaces all at the same time provides an opportunity to build fully diversified portfolio of only the new high growth spaces. This has not been possible in the past. This has been one of our strategies and the reason for our strong alpha generation over the past 2 years. Coming down to the next subject, macros. Well, the macro backdrop is good. Oil prices are low. Government seems to be on track to meet fiscal deficit targets. Current account and forex reserves are, generally speaking, in good shape. The global sentiment is to disengage with China to the extent possible, and this may continue to provide better access to Indian companies in the global markets. Yes, markets would have to digest volatility associated with the new regime in the US, but there is a great chance that it could be positive. End of fiscal year and budget are again expected to bring with them usual volatility that is encountered every year. But once again, the outcome can be on the either side, depending on what the measures are. Now, the weakness that we saw in quarter 2 in part was on account of slower government spending and better than the year before rainfall, which brought down economic activity. Because of stronger rains, spaces like mining, construction, and power generation saw lower growth. Now, in the second half, growth is likely to perk up as the benefits of good monsoons percolate down and the government spending gains momentum. A geopolitical situation is likely to undergo a change. Now, expectation is towards peace, with Trump coming in office in the second half of January. This could lead to a drop in oil prices, which is good for a large oil importing country like India. As we had discussed before, Trump coming in is a positive for two of our largest spaces in the markets, banks and IT. Banks could benefit as interest rates stay high for longer, and that would preserve their NIMs at higher levels. And IT could benefit as US Inc. invests tax savings into spaces like software. While we recognize this, we believe that the spaces we are invested in are offering significantly higher growth, and hence we continue to be less exposed to banks and large IT. Coming down to our expectations on flows, domestics and FPIs. Well, FPI flows are not likely to be strong because the US offers a very compelling story today. Interest rate in the West is high. Besides, most of the emerging markets are seeing issues and have not delivered returns superior to that of the US, weakening the case further. We believe that case for emerging markets may emerge after some time once the yields drop in the US to say below 4% and the market prices in Trump corporate tax cuts and higher import duties. Both of these could bump up corporate profits there in the immediate future. We hence continue to expect FPI selling on an overall basis, at least in the first few months of the new year, till it gets priced in the US. The story of calendar 24 was domestic investors, and the same is likely to continue in calendar 25. With rising per capita incomes, India is changing from a country of savers to a country of investors, and we expect this trend to strengthen and continue. At the same time, we believe that it is sentiments that make the market move up or down rather than flows. Now, CY24 has seen maximum amount of money raised from the market through IPOs, QIPs, OFS, etc. The point to note is that in spite of large fundraise record, long period record, which realizes a lot of flows into mutual funds, the market has held its level and has managed to move up. Now, our next thought is that it is now time for growth style of investing. We see returns as a combination of earnings growth and valuation adjustments. In value style of investing, generally, growth is compromised in the quest of value, and in growth style of investing, the opposite is largely true. one has to judge where a better combination exists. We believe that after 4.5 years of dominance by the value style of investing, value is drying up in the market and it is time for growth style of investing to manifest itself. In the new year, the growth style of investing should benefit from tailwinds from drop in interest rates across the world as well. In our portfolios, we focus on spaces which are tailwinded and are potential growth leaders in the economy. Managers aim to pick some of the highest growth quotient names in these spaces where valuations are supportive. We believe that in the new year, our style is likely to benefit from these tailwinds. So we believe we are nicely positioned. Thank you. Happy investing. Wish you all a very happy new year and may the good times continue.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.